Hi, folks. Good morning. Please let me know if you can hear me and see me and the screen as well. Good morning, Ritesh. Good morning, Bhavin. Good morning, Ayush. So we'll wait for some more time, maybe a minute or so, and then we will start. So the purpose of today's meet is an AMA session. So we don't have any real agenda or focus for this meet, but just to say hello and see where I can potentially contribute any uh, learnings with the larger group. Good morning, everybody. A lot of folks joining in. Okay, so the way we will work this hour is that we'll go through some market talk for few minutes, 3, 4, 5 minutes, uh, and then we will jump into questions post that. So I think we can start. We have a good quorum. Uh, so just a few minutes on where we stand in the markets and my thoughts about it. And of course, I reserve the right to be wrong at least 50% of the time. That much you can give me. Uh, my sense is that market is waiting for some sort of a trigger, and this entire recovery from the bottom of 4th of June, uh, this has been extremely fast and steep, and the buying power that was there in the market seems to have got exhausted in this move up. So, whoever had to sell sold off here, and whoever had to buy bought here. Now we need more buying power to really, have that kind of a trajectory upwards. Although the trajectory is still quite going well. I mean, of course, we if we see from November, we had a very steep rally, and then we kind of, went a bit sideways and gradual up. But this gradual up is also quite decent, I would say. I mean, this in the sense that from the start of the year, we are approximately, let me just do a index 200 and see where we are from. So we are up 8% on the Nifty. And if I see the small caps, we are up 21% on small caps, which is phenomenal actually, when we are not even halfway through the year. And Bank Nifty is where we may be struggling a bit, but again 7% here as well. And mid caps are up at 21%. So broader, larger part of the market has done quite well. And of course, Nifty Next 50 is just in another world, up 32% already. So from the perspective of gains in this current calendar year, we have already done quite well, and there is no harm if we sort of have a consolidation of period for some time. Uh, what you may have also noticed here is that after the election bounce back, most of the days have been red candles. I mean, not even one solid green candle. This also was a kind of a doji day. So last 9 sessions have been, people are coming to the market in a more optimistic mode, but by evening that optimism fades out, or some selling takes out that optimism by evening. So every day the close is below the open, yet over 9 days the market is gradually up. So this is, in many instances, if you go back to history, whenever there is concentration of such uh, lethargic moves, there is some shake off that should come. But we just had a shake off just earlier this month. So there are not too many weak hands also left in the market, not too many short positions that are not covered, not too many long positions that would have survived this. So we are in some sort of an equilibrium state right now, waiting to be disturbed again. Uh, and as you would have noted in the last 4 or 5 sessions also, every day there is one sector which takes the lead and supports the market while others correct. So one day it was pharma, one day it was metals, another day it was FMCG stock before that. Then uh, 2 days back you had IT stocks running. Then railway counter started to run. So it seems to be like a relay race between sectors, and in most bull markets that would happen. But consistently, sort of a meaningful gain on a day-to-day basis is not happening, which is a bit worrisome also. And maybe uh, it is setting a stage for some sort of a corrective move if possible. My gut feel is that while in the budget that is almost a month away still, uh, there will be some give outs in terms of some tax restructuring for the salaried class, and the rumors have been that 10 to 15 lakh slab will be tinkered around, but that will most likely release some consumption related liquidity in the system. And then of course there is this elephant in the room of FNO becoming a speculative category that I think can really mar the sentiment if it comes. A lot of liquidity in the system is because of people doing, at least larger options players, institutions involved in it, algo players involved in it are offering the liquidity. Even if we don't talk about whether they are making money or not, or what is their profit margin, but they are giving liquidity to the system, so that whenever you are transacting, or large institutions are transacting, the trade gets settled easily. um, so that of course is a worry, that no untoward step be taken by the government to unravel the liquidity that has come to the market. So if you just see the scale of uh, the liquidity that has come, even in terms of number of accounts, 25 years of markets before 2020 had 2.5 crore accounts. Now I think we are somewhere close to 13 crore accounts. So very rapidly new money has come into the system, and you don't want to scare it away also. So these are some of the current concerns. I think the market is waiting for some direction. Uh, by itself, as an absolute level, I really have no problem with this market. Uh, 23,500 coming off from 18,800 within a matter of 7 months is a phenomenal gain. Even if market gives up 5-10% anytime, I think that should be uh, embraced instead of getting worried about. So we are on a good path. I think uh, the FIIs are also not selling too hard on the sell days. They are selling net, but not selling off too hard. So from that point of view, the liquidity from that source is also maintained, and the local liquidity, of course, continues to bring in. Uh, so I think we'll open it up for questions now. Unless you want me to, go over some other charts that I haven't gone over. But I think let's have the people decide what uh, we should be discussing today. So just type in your queries. I'll take the queries here on. Um, let's the first query is from Ayush. Strong stocks consolidating without giving exit signal as per strategy gives temptation to exit and enter other strong stocks with the momentum. Should we shift our capital? Many times it works and many times it doesn't. So Ayush, the question is very valid. And in several of our strategies also, we will face this conundrum that the stock is not weak enough to give an exit, yet it is stagnating. So uh, there are few ways in which you can handle it. You can keep a timer exit, that if the stock doesn't move for for 6 weeks or 6 months or whatever maybe your timing, then I will, regardless if exit rule is not met based on price, I will exit based on time. That is one potential change you can make in any strategy. Uh, the other is, of course, if you are into more of complete momentum ranking or rotational kind of a system, then that gets eliminated on its own. So this is a problem of the absolute style of momentum investing, that stocks that come into your portfolio may just sit there, not deliver on returns, yet not get exited also. But then there are, as you rightly said, sometimes it works also. So there is no absolute 100% in anything. And I think depending upon the design of your strategy, you can introduce an element of the time in it. Uh, Soumyadeep says, is your system like MI20 and NF10 can give return like this after 20 years later? So 20 years, I don't know if I will be there or not, but the strategies continue to perform well. And I don't think human nature changes over time. That's what our back tests of, since some of the strategies were tested as far back as 2000 also. So nothing really changes from a perspective of a long-term frequency. Most of the changes are happening in the short-term range. So what was happening within 1 minute or 2 minutes is now happening within some seconds or nanoseconds. But the weekly and the monthly don't really change as much. And so from that point of view, I don't think human nature or algorithms driven by human nature. See, even if you apply uh, any algorithm or AI to the markets, ultimately it is your thoughts that are getting translated into that machine. So from that point of view, I feel that the natural system that we see today should not get impacted. But I mean, we will see when we come to that bridge. We'll cross the bridge. Uh, Night Fury says, why MI All Cap has 17, 18 stocks even in this type of market? So let's say we have 100 rupees and we've allocated 5 rupees to 20 stocks each, and we start off. Now what happens is one of the counter starts to become big, and it goes from 5% allocation to 7%, 8%, 9% allocation. Or let's say three stocks, and then one of your 20 stocks gets eliminated. And over a period of time, you find that the distribution in your portfolio is not anywhere near 5%. Some are 7, 8%, some are maybe near 3%, but yet not yet exited. So that distribution change causes some stocks to have more capital. So from that point of view, it may not always be possible that you have 20 stocks, because sometimes two losers who have dropped from, let's say, 5% to 2.5% each get eliminated, and now you buy 5% allocation. So you've reduced from 2 to 1 in this way, and that can happen over a period of time. When a very large gainer, let's say a stock which has got doubled or tripled, gets sold, then the re-entry probably will happen for 2 or 3 stocks at that point of time. So you will again see a rise in number of stocks. So the number will usually not go below 15, but it could possibly not be at 20 also all the time. So that is the and there is no detriment to the performance because of this. You are essentially saying that the stocks that are doing well, whose allocation has increased on its own, the weight is increasing on its own, you are allowing them to run. So again, by design, it is so in LCAP, all cap. But in NNF10, for instance, the same matter was happening, which is rotational in nature and monthly rebalanced. There, we basically rebalance it back uh, to regular weights. So 10 stocks revert to 10% each every month. So in that case, what happens is that you are allowing your winner to run, but you are cutting the profits off it. So some stock has doubled, let's say in a month. Then you remove all the profit and you bring it back to overall 10% of the current capital now. So in some stocks, profits will get removed. In some stocks which have weakened yet not exited, you will have more allocation. So there also that kind of system works. So it all depends upon the design of the strategy. I would not worry about it. Neeraj says fresh funds shall be invested in large cap, mid cap, or small cap strategies. So golden question: how to uh, predict what sectors will do how well. So, but if we see, let's say, Nifty divided by small cap index, uh, let's say, and we see the ratio chart of Nifty to small cap, you can see that over the last 3-4 years, small caps have really done much better than large cap stocks. This ratio is continuously going down, and at some point of time, large caps will also need to catch up. Uh, so it may happen that large caps do really well here on, small caps do well, but large caps do really well. That is one possibility which can bring back this ratio. Or the other possibility could be that we are in a decade of a market where the broader markets do really well and the large cap names do okay, but I mean nowhere near what kind of growth we are seeing in small caps. So again, it's a very difficult situation. Let me also show you one more chart of S&P 500 and let's say Russell 2000, which is the small cap uh, index. Now you will see what is happening is that so here the reverse seems to be happening. See, if I see the same chart of the last 4 years, here the large cap names have been rising. So this is large cap divided by small caps. Essentially, when the ratio is rising, it means small caps are shrinking or large caps are rising, right? In our case, in India case, this ratio, this is going up for US, it is coming down in India's case. So to some extent, this is showing that the economy in the US, the broader economy in the US is not doing well. It's only the large cap names which are, holding the market up, and the rest of the smaller companies are not doing so well there. In our case, it is exactly the opposite. Again, I will show you, uh, or let me just add on this itself. So if you're not using trading view, start to use this. This is a very good tool actually, and it will give you a lot of perspective on things. So let's just do this line chart. So can you see the kind of different difference in the US and India market? So this is India market where the large cap divided by small cap ratio is plummeting down last 4 years. And this is US market where large cap divided by small cap ratio is actually going up. So their money is flocking towards large cap and small caps are not doing so well. Here, both are doing well, but small caps are running much faster. So that's where we are. Very, very difficult to say what happens in the future, but I think large caps, and that may be just my guess, large caps should do much better than small caps going forward. But because we have such a wide diversity in small caps, and we have almost 6,000-7,000 names there, uh, you will always find pockets of fantastic growth happening in small caps as well. Okay. Cox backed Victor. I just hope everybody, should start using their real names, please. It just makes our recall easier. I mean, and the you know knowing each other is easier possible if you have a easy to remember name. Keeping the momentum tuning of NNF10 as it is, why can't we keep it as weekly review instead of a special rebalance? So again, I mean, a strategy is designed basis a lot of study, a lot of back test also, forward test. It's like saying that uh, an engine has been designed and now we should run it on a different fuel or something like that. I mean, it is not tested for that. If we can always create another strategy, a weekly strategy, which it has the same universe or can be a similar sort of a approach towards rotational momentum. The current strategy is designed keeping all that in mind. What will happen in some of the strategies will be that the churn will become very high in the very short term. If you go for uh, uh, sometimes concentrated strategies but weakly in nature, the churn may become extremely high, the transaction cost may become extremely high. So from that point of view, the outcome of a monthly strategy on that front looked good when it was designed. But yes, I mean, at all times we are trying to do research on new strategies, and maybe we will come up with some strategy on a weekly basis also. We'll keep that in mind going forward. Uh, Lucknow Super Giants fan says, I am already investing in MI25 and top 10 and all cap. Okay. I have few other mutual fund SIPs going. Do I need to continue or I can move that money as well in small scale? The good test about all this is compare over a 2-3 year period. What has your mutual fund delivered? And in the same space, what has your small case delivered? Let's say you have a large cap mutual fund and having NNF10, or if you have a small cap universe and you have MI25, just compare if they have been delivering in the same sort of bucket, what is the gap? If you find that small case is not doing well, move money from small cap, from small case to mutual fund or to some other small case. Or if you find that mutual funds are not doing so well for you, then you either move within mutual funds to some other mutual fund or you can come to small case. So this is how you will need to sort of compare and make a decision, or your financial advisor should be able to uh, advise you, because we really cannot advise you on what you should be doing with your money. uh, Dinesh says some portfolio companies have a rights issue. Any implications to small case returns if one subscribes or does not? So unless there is a rights issue which is phenomenally very meaningful in value, uh, there is not much point of disrupting the flow of your uh, portfolio. So I know which company you're talking about. I think the current rights issue that is there is not really meaningful, so you can ignore it. But as and when if there is one where people will have a better outcome if they applied for the rights. In most of those cases, potentially the strategy can get out of that stock pre-X rights and get in later in again, because having this disruption that you are invested in the stock, yet uh, you are waiting for rights, but exits happen in that stock, then it becomes very complicated for the small case system also to handle that. So from that point of view, right now you can just stay put on that. Atit Danak says, will would be a good to get perspective on MF inflows by Nifty 50, Next 50, etc. So I don't have this data that how much mutual funds are putting into Nifty 50 or Next 50 uh, space, but that is predominantly the major chunk of money that goes in the top 200 stocks. So I think it is a given fact that significant amount of money will go there. And I'll tell you the reason for that. The reason for that is many of these mutual funds are extremely large, 25,000 crores, 50,000 crores, 70,000 crores of AUM. And let's say a mutual fund has 50 stocks. So a mutual fund which has 50,000 crores of AUM has to invest 1,000 crores of AUM in every stock that they invest in. Let's say, assuming they are equally weighted, let's make that assumption also for safety, for easier sake. So if they have to buy 1,000 crores of one stock, they really can't go too low in the market cap, uh, ranking. Beyond 200, 250, 300 level of market cap, you start to get into illiquid zone, where getting in and getting out of 1,000 crores of uh, a position is not easy. You need a contra institution to buy or sell from. You can't buy or sell from the market then. I think if you go to the even 500th position, you will find that the liquidity has already become extremely low at that point of time. And below that, you will have companies which are not 1,000 crores market cap. Forget about getting a 1,000 crore position in them. So that is why mutual funds versus smaller fund managers like us, uh, uh, we have an advantage that you know we are dealing with very small amount of AUM versus these mutual funds. So we can still get in and get out of stocks without disturbing the market. But if our size becomes as large as a mutual fund, then you can't afford to have investments in lesser liquid. So hence all mutual funds will try to be on the higher liquidity side of the stocks, and have lesser transactions, lesser churn, because it is not easy for them to buy or sell, especially in the small cap side of it. There's a very famous small cap manager who got stuck few years back when he bought 5 to 10% of each of the equity companies, and he became sort of the elephant in the room. And that is some situation that fund managers should look out for, that as their size is increasing, they should cut off the supply of new AUM. The ones who have some uh, I would say uh, some sort of a self discipline, that I don't want to accumulate AUM for the sake of it, because the more AUM you have, of course, the more fees you are generating, but at the same time you are also making vulnerable the entire system by becoming the elephant in the room. So coming back to your question, I mean, most of it should be there, going there. Rahul Joshi says, how much CAGR you have made from inception? So all this data is available. You can go to the small case website. You can go to the weekend investing hub. Some of our strategies, since we started on small case, have made 20% plus. Some have made 30% plus. So all that data is very much available. Pankaj says, how to effectively rotate capital. So you can put your money in a rotational momentum strategy. We will rotate it very nicely, and you will always remain with the strong stocks in the market, and that's how you will rotate the capital. Otherwise, The other ways to rotate capital is that you find a strategy which can give you, let's say, even 10 basis points or 20 basis points of profit every day. And it is possible to do. And you put your capital there, make 20 basis points today. Tomorrow again, you come back with the increased capital, make 20 basis points again. And you will find that you'll make hundreds of percent of returns in a year. But finding that strategy and sticking to it is key. And of course, every strategy fails uh, above a certain level of AUM because the market cannot support it. Then you have to go find some market that can, absorb your capital. So why do you think, that large pension funds or institutions who have very large capital never trade in India? Because even if they want to, dip their toe in the Indian market, they will need even 0.5% of their AUM, entire AUM, if they want to put to India. Indian market cannot support that volume. So that's a tricky situation. But to rotate your capital, you need to find a strategy which has a positive outcome in terms of, if you do 100 transactions, let's say even 50 go right, 50 go wrong, you should be making more money in your winners than what you're losing in your losers, and you continuously do that. So a lot of options traders, option sellers are doing this. Actually, they are rotating capital. They have put up uh, capital towards margin in some sort of, maybe SGBs or Nifty ETFs, and they are having a strategy on top of that margin. So that margin itself is generating 10-12%, and the strategy may generate another 10 to 20%. So overall, they are able to generate maybe like 2 to 3% easily on that. But of course, there are risks involved in that. So that's some of the ways in which you can do that. This we've already taken. Saida says, do you see market correcting 10%? Yes, 10% correction can come like anytime. But one should not be fearing a 10% correction, is my view. I think if we are in the markets, we should not fear correction. We should fear that how we will behave when the market is correcting. Whether we will stay in discipline with our paths that we are chosen, whether we will gradually keep adding capital as and when it is available, uh, whether we will not, take out money at bottoms and add money at tops. All that is much more important. Market will keep going up and down. I mean, it is like a sine wave with a positive tilt. So you go 20%, you come back 10%, you go 20%, you come back 10%. That will continue to happen. So never worry about all that. Keep your horizon, at least 4, 5, 6 years minimum, and you will find that you'll do really well if you don't worry about all these things. Vyom says, is rural economy starting to revive? So is consumption theme attractive? So I'm not so sure about these macro trends. Every other day there is a contra report. Sometimes they say FMCG, the results come, the CEOs will say, rural economy is reviving. And next day they say we are having to sachetize things because, things are not selling. So it's best to sort of stick with, charts and what the chart is telling you. So FMCG has recovered. I think FMCG was not doing so well recently, but if I were to see since from start of 2024, we had a nice drawdown till April, and now we've retested this sort of top. And overall, if you see India market, I mean, FMCG has rarely gotten stagnated. This was one of the periods when it kind of stagnated 18 to 20 and small periods here. But continuously, the trend is definitely upwards. And the reason for that is that even if, the per capita income is not really going up exponentially, the new folks that are getting added to that mix every year, year on year, as people come out of poverty and as they become new consumers. I think that is a scale that we cannot imagine. Like yesterday, there was some data point about alleviation of poverty and how many people have uh, become new consumers. The numbers are mind-boggling in India, and that is something that one I think is always hopeful of, and that is a reason why all these companies trade at 70, 80, 90 price earnings ratio, which is actually, if you ask me, it is meaningless from a perspective of trying to value those companies, because they are so expensive that it is a joke. But because there is no alternative, I mean, there is no as of today, you can't find an alternative for a Nestle or a Lever or something like that. So the people have bid it up, so they are discounting the next maybe half a decade already. The earnings have been discounted. Uh, some things always remain very, very expensive, and this is the reason for that. That they know that in the next decade, more and more people will be becoming consumers first time, and then those who are already consumers will be consuming more. We are going to become a consumption economy like the US maybe in 20, 30, 40 years. So the path is set. They also know it, and hence investors also know it. So they are willing to bet on these companies. So 2, 3, 4 years, if returns don't come, it's okay. I know the path. People will not stop, buying these products. So that's where we are on that. Okay, Sarath has a good question here. How will auto renewal work if my card is blocked, or if it is renewed, do I need to pay the new price? It's a good question. I will have to go back to small case and get clarity on this. My own sense is that if your auto renewal does not go through, it will give you an option of 7 days grace period to renew it through other mechanisms. Uh, if that is also missed, then of course you lose that current price, whatever was there for that original product, and you will need to buy it at the new price whenever you do. So definitely don't, first of all, I must request all of you, don't cancel the auto renewal at any point of time. Some folks have this habit that, we don't know a year later whether we want to continue with this strategy or not. That's a fair ask. I'm not saying you will not have that ask, but don't cancel your auto renew. Let it come to that point of auto renewal. Even if it auto renews and you did not want to continue with the strategy, just send us a mail. We will refund it to you. That is not a question. But the problem happens where people will just auto renew it, and the next day they will cancel the next auto renewal, and a year later they would have forgotten about it, and by that time, maybe the pricing of the strategy also changes, and then they feel bad about it when they have to renew at the new price. So don't worry about the auto renewal. I mean, we will not penalize you if you did not want to continue. uh, Bharat says, what is the reason for Nifty Next 50 running so hard? I wish I knew, but I'm very happy to see that index do so well. And if we want to see it historically, let me just also show you that Nifty Junior, and let's compare it with Nifty, because both are large cap names, a large cap strategy. So you can see that, I mean, it has outperformed Nifty many times in the past. So this entire period of 97 to 2000, that was the first sort of rally here. Then you had 1 to 05, that this outperformed. Also this, oh 09 till 010, then 12 to 17. So there have been strong bouts of outperformance, but we are at the historical highs in terms of the outperformance of Nifty Junior versus Nifty. So it does outperform most of the times, but then there are periods of underperformance also. So this catching up or reversion reversion to some mean does happen. I think it is uh, mostly to do with the fact that stocks that are doing well in small caps become mid caps. Then that mid cap becomes a part of Nifty Next 50 at some point of time, the lowest 50 of large caps. And these are the budding stocks that can become a Nifty stock. So I think there comes a very sweet spot of a time when a stock is not really in the public domain, not getting researched so much. All FIIs and DIIs don't have it, yet it is performing very well. So we are that Nifty Next 50 is that sweet spot area where it is not overbought, yet it is scaling up and performing well. And once stocks go from Nifty Next 50 to Nifty, they stop the performance that they were showing in Nifty Next 50. And because at Nifty level, I think there is a lot of strategies that are attacking those stocks and derivatives also. There's just too much focus on those stocks. And it is also that, stocks become so large that it's not so easy to move those stocks easily, in a big way easily. And there was another study which said that once some Nifty stocks drop down to Nifty Next 50, they again start to perform. That is also some black magic that is happening. And so to answer your question very honestly, I mean, I don't know. But we are glad that we have a strategy which is running on Nifty Next 50 and it's doing well. Soumyadeep, I think I've answered your question. You put in like 15 times your question. Okay, Qureshi says, do you have a Sharia small case? So no, we don't have a Sharia small case, but what can be done if you would like is that you could take a small case and customize it and not buy those stocks which are, non-Sharia, for instance. Uh, that is one option that can be done. Or there are some Sharia compliant mutual funds also, as far as I know. You could go for that. Aiming for trends says, is it the right time to enter momentum small case now? If you are a timer of the market, then maybe we have more to lose than to gain in the short term. Let me put it this way, that we are at a position where we are not like midway, we are probably towards the higher end for the short term. But our none of our small cases or strategies are actually meant for people who are looking for short term gains. If short term gains happen, it is your luck and God's grace that you got it in short term. Otherwise, that by design we were intending to make some money in 5 years time. So if we are by chance we've entered the market and the small case at the time while one of those rallies which was to happen in those 5 years is happening, then you will make money immediately, and then maybe the second half of your journey may not be as exciting as the first half was. uh, but uh, I would say the best time to start any equity investing, not even momentum small case, I'll say any equity investing, was yesterday, and the next best time is today. So we've done many studies where you started from a market peak like 2008 peak or pre-COVID peak, and you gradually brought your money in. You always made money because the runway is very clear. We only need to stay disciplined and stay the path for us to make money. Uh, what is your view? Raghav says, what is your view on daily expiries and injections in options going 10x and going to zero? So my view on this is that uh, I mean, unfortunately, for the exchanges have become extremely greedy, And why should it, in fact, I shouldn't call them greedy. That is their business. Their business is to make sure they can get more and more transactions done. That is the business of a stock exchange. We make it a moral sort of a framework that no, they should not encourage speculation, they should not encourage gambling. But from a, if you see it from an exchange's perspective, they are a legitimate business in which the transaction makes them money. So naturally, they will want more and more transactions to happen. Similarly, for brokerage houses, brokerage does not care whether you are making money or you are losing money. Neither do have they have any moral compass that, because of our lowering brokerage rates, you are trading more and hence you are losing and hence I have to be blamed. All that doesn't happen in when you talk to those folks. In fact, I was running a brokerage house myself for 2 decades. So our effort was to earn brokerage. I mean, and there was no, uh, you know, nothing wrong in that. Of course, you wanted that you also do value add so that your clients make money, and you don't force them to do a transaction because you wanted brokerage out of it. So that again depended from company to company how they approach their clients, and maybe that is the reason why we got out, that we were bad at the skill of making people trade for no reason. Uh, so from that point of view, I think it's a way of gaming the system. The exchanges are gaming the provisions that they are allowed to operate in. Uh, for some reason, the regulator also approves all these daily expiries. Otherwise, the regulator could have clamped down even if the exchanges wanted. So I think there is some gap between the mandate that the regulator has to protect retail investors, etc., and what is getting delivered in the market. So if there was a tight gap between the two, then a person whose income is 1 lakh will not be trading 1 crore of options every day, which is happening by some reason because the leverage is so much. Now, Nifty in cash market, I remember when we were NSE members, used to give a intraday leverage of 35 times. If you put up 1 lakh, you could trade, 35 lakh rupees worth of single transaction, which even at that time, I used to feel that, this is quite crazy. Giving a few times leverage is okay, but, uh, you know, how you are not too far from, the speculative speculation as a classification. And this is exactly what I think the recent rumor is going around, that government wants to put all this as speculative because it is actually speculation. And speculation is not bad. Let me also qualify that. Somebody who is speculating need not be seen as a villain. I mean, it's a legitimate way of doing a transaction. Uh, People do it mindlessly without applying their mind and without having a strategy and ruining their own finances. That is a different matter. I mean, let's not go there. But the fact is that there is a platform which is fair to everybody. You could transact and others could transact in the same way, and you basically make money out of others' losses. So some people have a moral objection to that also, that 10% people make money because 90% are losing, especially in FNO because it is a zero sum game. Uh, but that's life. I mean, that's what all capitalist economies are doing in some way or the other. So, I mean, coming back to your question, I don't really would like to encourage all this. I think I've seen a lot of people ruin their careers, ruin their family wealth by jumping into FNO and not doing it properly, not having proper risk management, not keeping aside money for this. And the biggest problem I have is with those managers or influencers or intermediaries who egg on people to do more just to earn more commissions or profits from them. I think that is the major muck in the market. But I hope regulator will will bring some semblance to all this. Abhishek says, what is your view on relative strength concept followed and taught by Vivek Bajaj, sir? Is it worth to be followed for a lifetime to increase wealth consistently? So I'm not exactly sure what Vivek is doing, but whatever Vivek is doing probably is a good thing. I mean, he's a extremely talented and knowledgeable and extremely, I would say, a person who genuinely thinks good of others. So I'm pretty sure that whatever he's teaching or doing there is genuinely good. I haven't followed that particular strategy, so I can't really comment on it. Uh, but that's my feeling about him. Uh, Soumyadeep Panda has totally hogged the question bank. There are like 500 questions, same question 500 times. Uh, it's difficult for me to find a new query. Okay, good one. Anshul says, when you reach the upper limit of a small case, you want to invest more now. What is the smoothest process you recommend to now upgrade to new small case strategy? So whenever you feel that you are exceeding the recommended limit, feel free to add on a new strategy, because see, the intent of that limit is that the sanguinity or the safety of the system remains intact. If everybody puts in 10 crores each into a small cap strategy, then the strategy is gone kaput. Nobody will be able to buy, nobody will be able to sell. So we constantly monitor how many people with what kind of AUM are transacting every strategy, and hence also to diversify away risk from one strategy to the other, because every strategy need not perform at all times. There is some law of averages that gets there. So two or three different strategies are the best. And if you are, let's say, already in a large cap strategy, you are reaching some limits, take a small cap strategy or some all cap strategy or something like that, so that you can have more diversification. And this mindset I want to break down, that more stocks in your portfolio means lesser returns. This is totally, not true. Peter Lynch, when he was running Magellan Fund, he had hundreds of stocks in his portfolio, yet he delivered 29% CAGR for 13 years continuously. So our HNI Wealth Builder strategy, which has between 45 and 50 stocks at any point of time, has beaten many of the other strategies. So this whole concept that some little more stocks will hamper my growth, this myth needs to be shattered. Uh, Rohit says, why don't we move money to gold bees or silver bees when they look poised to do well based technical analysis? So the reason is that we are not in the business of a discretionary investing mode. We are doing everything on a non-discretionary basis. And the idea of utilizing cash while we are in cash into some sort of a short-term trade is that we are sort of, we are putting discretion to our uh, uh, thought process. The idea of going to cash is that the market is not doing well. The stocks have exited. We now have cash in the system. And now we are waiting for the next cycle to start and we deploy cash. Meanwhile, we can put them aside uh, into a liquid case. You can move it out and put it into your banking system. And if you feel so at your end that you are a good, technical analyst where you can make fantastic short-term gains out of spare capital, then feel free to do so. I mean, the liquidity is there. You can use that in your trading system, and whenever we, come back into any stock, you can release the money from there. But as a manager of a strategy which is oriented towards, let's say, large caps, and I have 5,000 people to answer to. Uh, if half of them say that I don't want my money to be trading anything, I came to your strategy so that I invest in large caps, and that's about it. So different folks will have very different outlook towards what risk they want to take, and not everybody is comfortable in trading. Not everybody wants to maximize the performance also. This is also another myth that people have, that we should go to the maximum returns strategy, or we should get the maximum returns. It doesn't matter. I mean, if you are doing better than most of the benchmarks out there, and if you are compounding, and if you are saving and bringing that money and compounding it, that is the difference it will make to your long term outcome of things. The compounding will make most of the difference. The rate of compounding is important, but not as much. Not as much. Even at, if somebody is compounding at 14-15% also, and he's doing some profession or business where he's generating surplus, that also he's adding on to the kitty, in 10-15 years, the kitty becomes very, very large, even in 15% CAGR. Okay. uh, Akanksha says HNI Capital Compounder and HNI Wealth Builder plus ATH2 a good combination, or you suggest to drop one? So the first two are good enough, I would say. ATH2, if you wish to add, you can add it. But the first two will give you enough coverage of most of the market space out there. Okay. Pooja says, what if India market becomes like Japan? I think before India market becomes like Japan, uh, US probably will become like Japan, and that is what some observers feel. But anyhow, coming back to your question, what if the India market becomes like Japan and we get into price stagnation? What if such situation happens? What should we do? I'm your MI20 subscriber. So thank you for being a MI20 subscriber. Let's go to Nikkei and see why are we not getting a long-term chart in this? Nikkei 225. Okay. Okay. So this is Japan. Let's go for a monthly chart. This is Japan right here. Now let's now Japan, if you see from, let's say, 1960, this stable period of 60s, from here it went up. If I were to go to this stable period right here, 2,844 is the markup. So 28 times is where we went in a period of about 25 years. Right now, imagine the kind of wealth you would have made in this crazy run. Right. So we quote Japan because Japan had a crazy drawdown post this run. So if we have a run like this, first of all, without worrying about this, let's get excited about this first. That if we are going to become Japan, then we should at least have this. Let Nifty go to 3-4 lakhs or maybe 10 lakhs, and then we will worry about the 10 lakh becoming 1 lakh again. But I think if there's any inclination that we are going to become Japan, I'll be the happiest, because in the next 5, 10, 15 years, it means there'll be mind-boggling, market action, price growth. And I actually genuinely I feel that a Japan-like situation can happen to India. to the extent that in few years time, if we are able to maintain, this best growth market status in the world, so much money can come into India that we don't have the supply to absorb that money. See, what is market? Why is Nifty 24,000 and not 48,000? Because currently the buying and the selling is at equilibrium at 24. Now suddenly, let's say $5 trillion want to come into India. Just imagine that there's something happens overnight, and all the wealth funds of the world, sovereign wealth funds, pension funds, tomorrow say that we want to buy Nifty. There are not enough sellers, there is not enough supply. The Nifty will go from 24,000 to 48,000 tomorrow. Right? So this kind of drawdown that happened in Japan came after decades of extreme growth in the markets, and we should first welcome that. And then, of course, we are having all kinds of protection built into our strategies. They will either go to cash or they will rotate into defensive stocks. And on top of that, you must always, have hedges. So as I talk about the hedge, let's say um, uh, what happened to Japanese gold holders. So see, when markets were falling, gold started to go up. So if you had a hedge of gold, if you were in Japan and you lived through this huge market run, right? And then you started to have losses in markets, but then, gold started to pick up also from that point of view. So overall, if you see, you would still have done very, very well. Of course, if you entered here, you may have had a difficult life, but uh, gradually, if you entered from here over the next 5-10 years also, you may have made something good. So I don't think, assuming that a Japan-like situation, and where is Japan today? After all this has happened, Japan is still one of the most advanced nations out there. I mean, the aging population is hurting them, but other than that, they haven't done so badly. So from that point of view, I don't at all at any point of time, think that we cannot go Japan way, but we are very far from that actually. Uh, there are many countries like US who will want to sort of, be a not want to, but will have to go through that process of, a higher, age brackets and aging population. Europe is also going through that. So from that point of view, I don't fear that. So I'm sorry I've come to the end of today's time. Lot many questions remained, but it was a good hourly session on different topics. I hope some people got some answers. I hope others got some good things to think about. And let's hope we have a great next week. Thank you so much for joining on this Saturday. Uh, and yeah, do send us your queries if there are any queries which you think that are essential and you must know the answers in a short period. Send us an email and we'll try to answer them. Thank you so much and goodbye. Have a great weekend. Bye bye.